Yesterday we updated the pivot point trading system to use as a filter, and I want to show you how we use that filter. First of all, take a look at the pivot point trading system as a base, and this is what we currently have going back about 10 years to 2002. $51,125 profit, $11,512.50 drawdown, and $33.28 average trade profit. Here's the equity curve. You see this big drop off. This was during the financial crisis, 2008. Lots of volatility, maximum spikes in the VIX, and the big drawdown occurred. And since that time frame, complacency has set in, and the market has gone up. And you also have to think about what happens when volatility gets really low. A lot of times when volatility gets low, the market just chops around and is more directionless, and even the tone is lacking, so that even when it hits that support or resistance level, it won't bounce very well. It might bounce, or it might just chop around. And so what we did with our VIX filter, taking a look at the inputs, we've updated these for those that currently have the pivot point trading system. We've added these three inputs: the VIX filter, false, VIX low, VIX high. And if you set this to true, we're just looking at the daily chart. It's data 6 on this strategy, and we're just saying if the VIX is between 18 and 40, we'll trade it, and if not, we won't trade it. Currently VIX is around 16. It's pretty low. And so let's take a look at how that affects the results, and I'm going to pause the video. Alright, we paused the video while that was updating. Now I want to take a look at the performance summary, and you can see over the same time frame, much better performance. The average profit per trade goes from $33 to $63. This is without slippage and commission. And so at $33, you're on the threshold of not being profitable enough. Since 2009, the base system has done well, but the drawdown is about half as much, 56.50. This is going back 10 years, and so you can see the performance improve. And I want to take a quick look at a VIX chart so you can see what we're talking about and why we have these ranges on the VIX. I'm going to pull up a chart. So here's a weekly chart of the VIX going back 20 years, and let's draw a line at our threshold cutoffs. 40 is here. You see those were some spike highs back in there. It doesn't change much. I tested at 35. It doesn't change much if you set it at 35. And then on 18 on the downside, and when you get really low volatility, you don't get a lot of action, and so you eliminate a lot of trading periods if you're not trading when the VIX is below 18. It's not above 40 much, but if you get this kind of VIX, you'll probably want to step away from the markets and not trade any of your current systems, like we did in the 2008 financial crisis, unless you're prepared for that kind of volatility and that kind of range. And so that's what the VIX filter does, and that's how you utilize it in a trading system. And we'll have more on this, more research on this, and at a later date to tell you how that affects our other trading systems.